Our next guest is part of that group, raising his S&P price target from 6,500 to 6,600. Joining us here at Post 9 is Barclays head of U.S. equity linked strategy, Venu Krishna. Venu, welcome back. It's great to have you.
Thank you.
What do you see coming together in the next year?
I think we are optimistic. And I think there are two core reasons why. First is the continued expectation for U.S. tech exceptionalism. And the second, is the fact that right now the consumer is in great shape. Consumer balance sheets are good. Unemployment, even though it's sort of cooling off a little bit, it still means that consumers are spending, both on goods and services. And the virtuous cycle between employment, income, and consumption remains in place. So I think when you put those two things together, overall we remain optimistic. We think earnings are going to increase about roughly 12%, which is very healthy and a pickup from this year.
Sure. Does your sector playbook change as a result?
Yeah, in fact, a lot of changes. So on one hand, we continue to remain positive on big tech. That's an area in which the street has systematically underestimated their earnings power, while we have been on the other side. But at the flip side, we have upgraded healthcare to positive. So we used to be negative. Good earnings momentum. They're going to be beneficiaries of the new administration's policies. It is significantly under-owned, and it remains relatively cheap. On the other hand, we downgraded staples. So ongoing margin pressure, ongoing volume pressure, and this is one of the sectors who exercised fair degree of pricing power during post-COVID, and we don't think that's sustainable. And if you recollect, at that time, staples companies was telling people that demand has become inelastic. We were skeptical, and indeed, demand is turning out to be more elastic than what people thought. And so that's one more. And then we upgraded industrials to neutral. We're still not positive. So a lot of changes, but big picture, the fulcrum of this market remains big tech.
Does it need Fed rate cuts to continue to climb? Because as I talked about earlier, it's not so certain that we're going to get a bunch more rate cuts with the economy doing so well.
I agree. So I think our view is that valuations are quite full. So valuations are not going to be the source of returns next year. It has to come from earnings. Now, the principal risk we were concerned about is the nominal 10 years going up. That seems to have eased more recently. It's come down about 20, 30 basis points in recent time. So my point is that if Fed goes a little easy, that's not negatively necessarily a problem. In fact, if they cut too fast, it's a problem. It means the economy is falling apart. And if they raise it, we have a problem because inflation is picking up. So we are in a sweet spot where growth is moderating, but earnings growth is still robust, and valuations are full, so you want to pay attention to what multiples you're paying for the market.